We're going to talk today as we start this with a couple that really took a big loss in their, and I don't know how they did this over the last couple of years, but obviously they didn't have an advisor. Woman writes into the Yahoo Finance advisor column, and she says, our investments were at $450,000. Now they're at $250,000. How do you lose money in the last couple of years? I don't know. But it's interesting that she asks this question. How much do I lose before I go to cash? When it comes to losses, when is enough enough? Well, Jay, you've gone through this. You've gone through 2008. You've gone through 2000, and you've watched people. Where is it that people finally say, that's it? I'm going to cash. I'm not going to lose any more. And how could we avoid this situation altogether?
My first question is yours. That's almost a 50% loss.
Yeah, how did this?
And you got to have a lot of talent to lose that much in these markets. Unless she was in Bitcoin or something, I don't know. I would reframe the problem and the situation into a different lens. Okay. And it is about, I'm assuming, I don't know if you mentioned it or not, I'm assuming this lady's retired or she's planning for retirement or something, right? I don't think she would be as panicked about this if she had other irons in the fire, for want of a better word. Right? Mm-hmm. When you move from work life to retirement life, everything is changing. You're going from, a place you went to work for 40 plus hours a week, occupying a good chunk of your time. You went to a paycheck coming in, however you got paid twice a month, every other week, whatever it is, accumulating funds in your retirement accounts, to now turning that whole thing on its head. And you got more time on your hands, which is great. It's probably what you wanted, right? You wanted to be able to have more time to do the things that you liked. But now also, instead of accumulating funds, you're going to be distributing those, and you've got to find a way to make that last the rest of your life. This is why we talk about 401k money coming out of the 401k. And people ask us, should I move my money out of the 401k? And I say, I'm not going to tell you whether you should move your money out of the 401k. I'm just going to talk through a few different things about what your situation is inside the 401k and what your situation is outside of the 401k. And most 401ks, you've got a handful of investment options. You've got 7 or 8 target date funds, and then you've got another 8 or 9 other funds that you can invest in. Now, while you're growing your money, that's probably okay. Once you're moving into retirement, you want to do several things. Do I want a bit of growth? Yeah, I want a bit of growth. I can't stick my neck out there too far. I also need some income. There's all these other things going on that probably your 401k doesn't have enough options to achieve. You're also essentially your own advisor while your money's in the 401k. You're the one making the decision. And that's evident when we ask people, hey, how did you come to this allocation that you have in the 401k? And it's, I don't know. I talked to my coworker a few years ago and this seemed to be okay. So we just put it in that and I left it. I never changed it, right? So getting your retirement set up so your income needs are taken care of, and you have a bucket that's growth and you have a bucket that's conservative. And having these things addressed helps to diminish some of the concern, because she's saying, when do I go to cash? The next thing that's about to happen to this lady, I can tell you, is if she's already asking, when do I go to cash? She's almost there, right? She's probably going to make that decision pretty soon. And she's going to get into cash, and then hopefully this is some sort of diversified portfolio she's in. I don't know how it could be if you're down 50%, but anyway, she's going to get into cash. And then the next question is, well, when do I get back in? What do I do now? Is cash the long-term solution? It's not. Everybody knows it's not. People have been in cash for a bit now because interest rates are higher, and everybody who was in cash saying, I'm getting 5% in the money market, this is fantastic. I said, yeah, that's great right now. And I'm not saying you shouldn't take advantage of it. What are you going to do when that 5% becomes a 4 and it becomes a 3? And that's where we are now, right? It keeps going down and down, so it's not a long-term solution. And let me kind of tie this all together with a story that we had from someone who's not a client anymore, because after this event, we basically had the discussion that we're not the right fit for you because you won't let us help you, right? And we had a client come on board, nice guy, an aggressive investor by his own standards. He says, I'm an aggressive investor. And I said, if you insist on us investing you aggressively, we will do as you wish. It's not our recommendation. It's going to be notated very well that this is not our recommendation. I know you're used to doing this in retirement, being invested this way, but you're in a different stage of life now, right? You don't have the security of a paycheck coming in every couple of weeks. We've got to make the money happen with your IRA now. You don't have as much time as you used to back, when you were working. You might have had a 10, 20-year runway before your retirement. You're in retirement now. Things are different. No. I'm an aggressive investor. Okay. You're an aggressive investor. So we get set up, and this is probably in 23. So everything's going fine for a while, and then March of 2025 comes, all right? So, 12 months ago. And just to jog everyone's memory, you probably remember this, Randy. That was when Trump came out with his tariffs. And, everything was kind of a little bit rattly there for a while. And then the market just fell off a cliff, right? And I can't remember the exact numbers, but it was something like we were down 15% in a matter of a week or something. It was tough. It was a 5% down day followed by another 5% down day. And this gentleman called us freaking out. And the first thing I said to him was like, do you remember when I said you're not really an aggressive investor? Right? This is why we had this conversation. And so he says, well, I want to get half of my money out of the markets. And this was, a couple of days in. And, we try and talk him through it that, we're in this portfolio right now. It's probably not a good idea to exit it while this is going on. Let's give it some time. No. I've got to get half of it out. All right. Hey, ultimately, he's the boss, right? It's his money. So we got to do what he says. So we go ahead and do it. Another day or two goes by. The market's still just going down. And he calls in, and I talk to him personally, and he wants to get everything out of the markets. Now, I might be getting a day or two off with this, right? Because it is a year ago. This was on either a Monday or a Tuesday. And I'm talking to him. I talked to him for probably an hour, trying to just kind of like rationalize things, talk him off the ledge. And ultimately he said, no, I want everything out of the markets. So now, we got, it's his money. We got to do it. So now he's 100% out of the markets. All right. The next day was the day that Trump came out and put a 90-day pause on the tariffs, and the NASDAQ was up 12% in one day.
Right? He missed that run up. He
missed it. And, he called in and we're talking, and he's like, no, I'm not going to get back in because this is just a bounce. It's going to crash again. And at this point, we're kind of like, all right, dude, whatever you want to do, right? The damage is done, right? Anyway, so, a bit of time goes by and we have the hard discussion of, you probably need to find somebody else, right? Because this is, you're sabotaging yourself. I don't know what happened with his situation, but the market has been pretty much, there's been some bumps here and there. It's been pretty much straight up since then. So not only did he miss the recovery, he's probably missed another 20% on top of that. This is the issue this lady is going to then run into, is now I'm out of the markets. Okay, the bleeding has stopped. Now what do I do with it now? And this is all due to not having a comprehensive plan in place. That's what it is.
It's an interesting question. I mean, any financial advisor is going to look at you as a new client, and they're going to try to get a bead on your appetite for risk. And they're going to ask you a question like, how much are you comfortable losing? And you look at them and go, really? That's what you're asking me? It's like a baseball player looks at his coach, and he's a brand new player. He says, how much are you comfortable with me striking out? And it's like, yeah. I mean, seriously.
Yeah.
So here's my thing about that. If you don't know what to talk about with a financial advisor and you don't know what to ask, once you get figured out how much you need per month, look right at them and say, I need $7,500 per month. Don't ever put that in jeopardy. And see what they say, because that's going to be your risk profile right there. Is this has to come in every month, whatever's happening out there in the market, whatever, I need this per month to survive. This is what I need. And that's probably going to be a real good opener for the conversation.
Yeah, that's a great way to start the conversation. And think of this as well, right? And we're just kind of throwing numbers against the wall here because everyone's situation is a bit different. But if you go in to come and visit us, see your advisor, whatever it is, and you have that conversation you just had with them, Randy, and you said, I need X amount of dollars monthly. I need 5,000. I need 7, whatever it is. I don't want to have to worry about that coming in. I don't want a situation where Trump decides to do something and the market goes down 15% in a couple of days. I don't want to have to worry about it. I don't want to have to worry about an Iran-US conflict or whatever other geopolitical event is going to come up, right? I don't have to worry about that. And let's say out of your $1 million, it costs half of your portfolio to do that. It costs $500,000, right? And as I said, we're throwing numbers against the wall here. Look at the freedom that's given you. The rest of your life is guaranteed on your income. And the second part to that is that $500,000 that you have left, you can get super aggressive with it. You can invest it very aggressively. You know, they say that, you know, the more aggressive you are, the higher the return in the long run. In general, historically, that's true. Unfortunately, it's not a line at a 45-degree angle. It's this jagged chart that goes all over the place and then eventually over time ends up higher. But getting the planning done, like simply we just talked about, it allows you security, freedom, and growth potential in your remaining money.
You're listening to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management. Online, it's retire210.com. Go to the website today, tool around a little bit, learn more about Jay and the team. And down at the bottom of the page is a place for you to put some information in there. You'll see Jay's book, which is called Wall Street's Game. If you make an appointment, get a date on a calendar, come on in, we'll give you a copy of that book. If you want to get a little taste of it, you can download a chapter from that book just by going to the website. So give you kind of a little look at what Jay is all about. The important thing is getting a date on a calendar to talk about your retirement. Get your eyes open, know what you're up against as you go into your retirement years. Let's get something down on paper.